When a company goes public, they need a partner to sell their shares. This contract is the foundation of that process. An underwriting agreement is a legal contract between an issuing company and the investment bank managing the stock sale. The bank acts as a middleman, ensuring the company gets the capital they need by taking on the risk of the offering. These documents outline exactly how much the bank is paid and how the final price of the stock is determined. The level of risk taken by the bank changes the agreement structure, either as a guarantee or a best effort campaign. Fees are a major part of the agreement, often taking a small percentage of the total capital raised to cover costs. Without these agreements, the transition for a company to join the stock exchange would be far less secure for all parties involved. Understanding these legal documents helps you see how capital markets function behind the scenes. Subscribe for more finance basics.